More big bank earnings and a bumpy start for stocks in 2024. I'm Lisa Bernhard with Reuters, and I'm joined today by Eric Diton. He is president and managing director of the Wealth Alliance. Eric, Goldman Sachs and Morgan Stanley both reported earnings today. The latter's down about 5% as of this moment. What struck you about their earnings reports?
Interesting, a real divergence between the two. Morgan Stanley, at first glance, the earnings looked terrible. There was revenue higher than expectation, but the earnings looked bad. But there were two one-time charges, and once you got past that, the earnings were okay. What the street focused on was a reduction in margins in wealth management. They didn't like that, and that's really the core business at Morgan Stanley. But beyond that, Morgan Stanley had a lot of warnings in there. Talking about a possible economic slowdown and what if the Fed has to scramble and really cut rates to avoid a recession. So they threw that out there. Then they threw out inflation, and they went the other way. They said, well, we could have a lot of inflation, and then the rates are going to be higher for longer, and that's not good either. Why are they doing this? My gut is that they've got a new CEO, Ted Pick. I was at Morgan Stanley for 10 years when James Gorman was there, very sharp guy. Ted Pick is new. I think he's hedging. He's just saying, just in case things don't go well this year, here's what could happen. So that's Morgan Stanley. Flip side, Goldman Sachs has really been having a rough time. They had write-downs last year. This was a great report. Revenues well above expectation. Earnings blew it out. They're big in M&A. They're very optimistic in M&A, and we see it. There's been a lot of takeovers just in the last few weeks, a lot of activity, so they're very bullish there. Their trading revenues were up. Really just a really clean report all the way around.
These two were reporting on the heels of big banks kicking off earnings season on Friday. Is there any central theme that we're seeing among these big banks for the economy going forward?
Well, I do think that it's the economy, stupid, right? That's it. This year, the Fed is done hiking. And when's the Fed going to cut? Well, what's inflation going to do? What's economic growth going to do? Most people are predicting a slowdown from last year. I am. I'm not predicting a recession, but certainly higher for longer. Over time, it does slow down the economy. So all eyes on the economy. And that's going to tell the Fed what to do, and that's going to instruct the markets how to react.
All right, it's been a bumpy start to the year for stocks. Today, we're seeing Apple down, we're seeing Amazon, Meta Platforms, some of the so-called Magnificent Seven that led the way in 2023. Will these stocks continue to lead the charge this year?
Well, first off, let's just be clear. We were due for a pullback. We had a tremendous run from the end of October right through year end. I believe there was a lot of window dressing as we got near year end. A lot of money managers were like, I've got to be in this market because I've got to show everyone we were in there and not holding a lot of cash. Now, the Magnificent Seven led the way. More than half of S&P 500 returns last year were those seven stocks. I think the worst one was Apple. It was only up 49%. And NVIDIA was the best, and it was up 239%. And the others were all in between that. All of them way more than the S&P. So is that sustainable? I say no. By the way, I'm not saying go out and sell your Magnificent Seven. But I do say it shouldn't be 28% of your portfolio like it is 28% of the S&P. That's a big bet on a handful of mostly richly valued stocks. They're not all. I mean, Alphabet is reasonable. Believe it or not, NVIDIA is actually reasonable given its earnings growth. It's only trading in the 20s PE-wise, which for a company at doubling earnings, that's not bad. But look at Apple. Apple's had 4 consecutive quarters of declining revenue. Just cut prices 5% on the iPhone in China. So there's questions, and they're still trading in high PE levels, high 20s, and they're not growing nearly as fast. Great company, but what's it worth?
Okay, I'm going to turn now to geopolitical events because today we saw more U.S. strikes in Yemen in retaliation for the Houthi attacks in the Red Sea. Markets have largely shrugged off geopolitical events. As the U.S. moves deeper into the Mideast conflict, do you think that this will affect markets soon?
Right now, the US, I believe, is viewed as a stabilizing force in the Middle East because the issue is shipping. And I just read something recently that a 40-foot container out of China was charging $2,900 recently, and then it shot to $10,000. Want to talk about inflation? That's a game changer. So the U.S. is going in there to try to make the Red Sea shipping a safe lane. That's viewed as a positive. And so that's why you're not seeing the sell-off. Now, if the U.S. ends up invading Iran, I don't think that's going to happen. I'm just giving an example. That would be a big sell-off. You go back and look at the Persian Gulf War in 1990, that Persian Gulf War, we went in there, the markets initially sold off. But you look at 2003, when we invaded Iraq, the markets rallied because there was never a fear of a big, broad geopolitical conflict there. So it all depends how involved we get.
And what about politics, which is something the markets have also largely shrugged off? It's looking like it's going to be another Trump-Biden showdown among a ever deepening political divide in this country. Do you think that that will eventually rattle markets?
I have a number of concerns. One is whoever loses, are they going to accept the election results? That's a real issue. And then we've got a far left and a far right. And it's getting a little scary out there. I mean, we are really polarized. This election is only going to hurt that. So we're a very, very resilient country. We've had some really rough elections. We've had some horrific presidents over the years, and yet we survive. It's the balance of power between executive, legislative, and judicial, and that works. So there will be volatility and aggression, but I'm not going to say that means the markets are going to sell off. It does mean volatility, though.